Okay, well, hello everyone. Good day, and what I'm going to try and do here is I have received a number of questions from you on capital markets, and I have gathered them together in one file, which is the one that you now see in front of you. It is tutorial session 5. Now last week I didn't have a chance to go through all of them, so I'm going to try and take this opportunity to answer these, so hopefully they will end up helping you in your revision, especially for Rose K's midterm. So all the questions are already there, and I will go through them one by one, starting with this one. Now this question is basically regarding the relationship between what coupon you paid for a convertible bond and the various other characteristics behind it. Generally, the thing you have to remember is anything that makes the CB attractive to an investor is a factor that would persuade them to accept a lower coupon. Okay, that's how it works. So any feature you have that investors actually like will give you a case or a chance to bring down the coupon rate. So for example, if you actually scroll to later on in this section, in this tutorial, round about page this page here, okay, where I at least try to outline. This is the table that was in Rose K's notes, but all the boxes were empty, so I tried to fill them in. Now you notice, so the question that was asked essentially relate to the last two items: stock borrowed cost and CDS liquidity. I think you have to understand a little bit more what really is a CB, and I'm sorry that we didn't have time to go through that in more detail during the tutorial, because there's been so many presentations. But basically a CB is nothing more than a bond, a normal bond plus a call option. So maybe normally when an issuer is issuing a normal bond, okay, the bond might look like this. So you pay coupons and then you pay a normal bond, okay. So a CB is nothing more than, okay, instead of paying you a normal bond, I'm going to pay you slightly lower coupon. So I'm going to take off all the shaded parts, and instead I will give you, as an investor, I give you a call option. Okay, that's all it is. And occasionally the call option is sufficiently attractive or is worth enough money that they actually completely take off the coupon, so it becomes a zero coupon. The Microsoft deal that I hope by now you are familiar with, or the Temasek, was precisely that. Okay, so if a CB is nothing more than a bond and a call option, then the question to ask after that is, well, what kind of risk comes with a bond? What kind of risk comes with a call option? Now, first of all, with a bond, you are taking credit risk. That's it. Okay, and in order to hedge credit risk, the best thing to do that is to use a credit derivative, such as a credit default swap. for instance. Okay, so if there, first of all, if there is an existing market for credit default swap for a particular CB issuer, okay, that's going to help you sell the CB to investors. You have to think of it like that. Okay, so if you are an issuer, what are the things that are going to make it attractive for a CB issuer? So if some investors are able to hedge their credit risk, this is something that they would like. So that would help. First of all, is there even a CDS market? And of course, if there is, then the better the liquidity, then the more investors would like it. So if liquidity is high, if liquidity is high, then you can conceivably bring down the coupon rate. Okay, that's why we talk of a negative correlation. It's not really negative correlation is not a good way of putting it, because there's not a statistical causation like, you know, smoking causes cancer, that kind of correlation. It's just that they will move in opposite directions. It is true. Okay, so a better liquidity would help an issuer bring down a coupon. Now, when we talk about borrowing rate, stock borrowing cost, okay, what does that actually mean? Oh, it's not here. Hold on. The slide I'm looking for. This one. Okay, stock borrowing cost. You have to understand the way. First of all, I'll take a step back and to share with you some typical market nuances or characteristics of convertible bond. Convertible bond often finds a very supportive investor base in hedge funds. Okay, so hedge funds like to invest in convertible bonds. So on average, any CB that is out there, when you are pricing it, you could conceivably get anywhere from, I think, 25 to 35% of hedge fund participation. So hedge funds are a very important component of CB investor base. Not only that, okay, the issue here is how hedge funds actually invest in CBs. Now, they don't just buy the CB and just sit on it. The CB has credit risk, like I said. It also comes with a call option, okay? And a call option, as you should know by now, the price of a call is affected by many different factors, apart from interest rate sensitivity. That one is called Rho, but that's not really a very it's not really the priority one. It's affected by obviously the spot price, of the underlying stock. It's also affected by volatility. The way hedge funds trade is they like to trade the call option. Sometimes they trade the credit as well. If they don't want the credit, then CDS obviously becomes relevant. So that helps. But when they trade the call option, typically they like to trade the volatility. And maybe the market, sometimes even when the price doesn't change, the spot price doesn't change. The option price can change because volatility is changing, and hedge funds are you know, they like to take positions on that precisely. They don't really care too much about spot price movement. So when they buy a CB on Microsoft, it isn't really because they care about the stock price movements of Microsoft. If they did, if they want to make money from a rise or fall in Microsoft share price, just go straight into the stock market. It's far more liquid. Okay, so you got to think of it like that. And so they like to trade the volatility, and the way you trade the volatility is you try to delta hedge the call option such that when the spot price is rising or falling, it doesn't have, or it has minimal effect. I wouldn't say zero. It has minimal effect on the call price. Okay, and if you are long a call and you want a delta hedge, you actually have to short sell some stocks. Okay, now here is when the next slide becomes relevant. How do you short sell? Well, you short sell, and I have said this numerous times, including in investment and portfolio analysis. On the first tutorial I mentioned the importance of short selling because it crops up everywhere as a concept, not only in derivatives, but here in this instance, short selling is part of CB hedging, which is part of what hedge funds do when they are investing in convertible bonds. So you actually need to be able to short sell, and the way to short sell is you need to be able to borrow the stocks from somebody in order to dump it into the market and get cash and so on. Now, so when you borrow stocks, then of course the stock borrow cost becomes a key consideration. What do we mean by stock borrow cost? When you borrow something from someone and they lend it to you, they're not doing it for fun, or they're not doing it to be nice. You get charged for it. So you think about this. If you are the investor and someone is asking you to buy a CB, and you know that it's very likely that you're going to try and hedge that, delta hedge that by going short, then that means you need to be able to borrow the stock. Then the key thing is you're going to ask yourself, is it even possible, number one? And number two, how much does it cost? Now, the cost for borrowing stock A and B and C and D, they don't have to be the same. Okay, so some stocks are very hard to borrow, so they would cost more. Some stocks are very liquid. I imagine actually the underlying stock liquidity has something to do with how easy or difficult it is to borrow stocks, although it's not necessarily always the case. Okay? I would say a stock that trades infrequently certainly would be very hard to borrow, so the cost will be high, and a stock that trades frequently with lots of participants and sufficient market float is likely to have a lower cost. But in any case, so if the cost is very high, if the cost of borrowing is very high, then generally that is not attractive for a CB, a hedge fund type CB investor. Well, a high borrowing cost is not attractive for anyone. Okay, never. So of course, if the borrow cost is very high, then investors are going to say, oh, hold on a second, I need to factor that in, because if I was to buy your CB and if I take a delta hedge and I need to short your shares and I need to borrow, the cost will be high, so please pay me a high coupon. Okay, so conversely, I say the lower the cost, the less coupon is needed. Okay, that's the reason behind that. All right. Now let me go to the next question. which is this one. So dear Sam, this is S from Capital Markets. Sorry to bother you on weekend. No, don't be sorry. I have two questions regarding DCM. First, when the professor talked about hybrid tier 1, she said hybrid tier 1 has a coupon step up sometimes, not always, which lowers the incentive for companies to call back the bonds. Can you explain in more detail? Because I only know that companies are motivated to call back bonds when interest rate is lower. No, I fear that you have a misunderstanding. Cross out this word, not lower. It would increase the incentive for companies to call back bonds. Now, I'll tell you what coupon step up is. Okay, coupon step up is simply this. So you buy a bond, and maybe it's a 5-year bond, but it's callable in year 3. So in year 3, one of two things will happen. So either the bond gets called back, then you get paid par, or if the bond is not called back, the coupon, if the bond is not called back, the coupon will step up. Okay, and then until year 5, and then you get paid par. Now, from an investor's point of view, it is kind of, a psychological additional comfort that if I have to hang on to this bond for another couple of years, at least my income increases and I get compensated for that extended exposure. So that's easy to understand. And then from the issuer's point of view, in fact, I think they are kind of sending out a signal to investors that, well, look, if I don't call back the bonds after year 3, I have to pay you more, and I know that, and you know that. So I'm kind of sending you a signal that there is an incentive for me to call it back, and if I don't, I will compensate you for it. So I think I fear you might have heard the exact opposite, or you might have misinterpreted. That actually increases the incentive for companies to call back bonds. Okay, of that I have no doubt. Now, second question about tier 2. In the lecture notes, page 45, it says the main components of upper tier 2 includes permanent cumulative preference shares. But in page 47, it says the one advantage of tier 2 for banks is to avoid liquid equity dilution. I'm wondering whether these 2 points are contradictory, since preference shares are also components of shares outstanding. Wouldn't issuing preference shares also cause dilution for existing shareholders? Well, first of all, if you go to the next slide, this set of slides is already in Blackboard. So I try to, this is a graph actually I sourced from bank and insurance capital, but it's pretty good. So preference shares are it counts as equity technically, but it is not. The common shares that are traded, it's not common equity. It pays a fixed dividend, and you have different voting rights. So it's a different class of shares. Well, yes, I agree. It dilutes your equity base, but when you see a stock price being displayed in Yahoo or Bloomberg, okay, that stock price is the price of buying one share of common equity. So the price of preference shares or the valuation has nothing to do with it. So in that regard, it does not dilute your common equity. I think that's what we mean. So we are specifically referring to, so you're issuing something which is technically equity, but it's a different class. Okay, so it should not put as much pressure on your stock price. Of course, if you're going to really load up and issue tons and tons of these, that's a different issue. But generally, issuing preference shares would not have immediate direct impact on your share price. The way that a rights issue may certainly, or a follow-on offering of some other kind, certainly would have a direct impact. Okay, that's what we mean by that. Okay, now I have some other slides you can take a look at, and I'll try and explain these in the last tutorial before the midterm, but you are free to have a look. Okay. Now here's another question. Dear Sam, happy weekend to you. I have a question regarding CB, I think. So why, when it is opportunistic issuance or acquisition scenario, issuance of CB makes sense? Actually, I don't understand what opportunistic refers to. As for acquisition scenario, my guess is that usually after acquisition, the company will become more powerful and buy the growth of the company and think in the future their call can be in the money. So they buy the CB. Am I right? Yes, I mean generally that is true. I think what we mean by opportunistic, it is a word that's often used, but also often poorly understand. The way I look at it is like this: when you look around, next time you pick up a news report and you start reading about company ABC, company XYZ issuing this and that and this and that, whether it's bonds or equity or pref shares, CB, whatever, okay, I think it can be one of two reasons. Reason one, they're not really doing well and they need money, okay, and they're desperate sometimes. Reason two, they are doing well and market conditions are good, so that when they sell something, they are likely to be able to sell at a good price. Okay, I mean, it's all about timing. That's the world we live in. Everything is about timing. Do you sell yourself at the top of the cycle, or do you sell yourself at the bottom of the cycle? Okay, sometimes looking for a job is a little bit like this, I'm sorry to say. Now, opportunistic, the way I would understand that is trying to sell something at the top of the cycle. Okay, so you're not really desperate for funds, but you see that market conditions are good, and if you think you can suddenly raise a couple of $1 billion at a very cheap cost, and you think you can put it to good use, nobody in their right mind will say no to money. Okay, so if you think conditions are good, why wouldn't you do it? Okay, so in the next slide, I try to sort of put those thoughts in a matrix, in a box format, and if you need cash, market conditions are good, well, that helps you. When market conditions are good, there's probably a higher likelihood that your company is also making good money. Okay, if market conditions are good and your company is doing well, but your company does not need cash, then this is what I would think. This is what the box I would associate with the word opportunistic is you see a market opportunity and you try and take it, although you don't really have to. Okay, That's what opportunistic means. And I think you see a lot of if you really want to have examples, I would say the Temasek deals, the EB that they issued on Standard Charter is a good example of that. I think the Microsoft trade strikes me also as a good example. I think the AIG sell down of AIA also was opportunity. They are looking for a window. How about that? Okay, they are looking for a window of opportunity. It's often the way we say it. Okay, and they found one and they took it. Okay, that's what opportunistic means, which means you don't have to do it and you're just sitting there waiting for the right time. Okay. Now this one, I come up with a question about Basel III. It says that there are some additional tier 1 and one is dividend stopper. The additional tier 1 assets and dividend stopper is one of the features that sometimes you have for certain lowly rated bonds. So dividend stopper is if you don't pay me, if I'm the bondholder, you don't pay me a coupon, you cannot pay dividend. I'm going to stop you. Okay. Rose mentioned HSBC as an example, saying that since the number of equity of HSBC is quite large, but the additional tier 1 bonds, I guess, or whatever instruments are in there with dividend stoppers accounts for only a small portion. It is almost impossible for HSBC not to pay the dividend in order to avoid paying coupons. So this kind of AT1 can rank higher than stock and get paid before stock. However, I think tier 1 assets are those that are subordinated to most of the capital, and the bank can almost ignore the payment for these assets. The example given by Rose seems to say that the dividend stopper can ensure the holder to get paid, which means the bank surely will pay. Why this kind of capital can be considered tier 1? Okay, now you can go back and look at. Here is the hierarchy. So common equity tier 1. So obviously this one is the lowest priority. Okay. It doesn't mean it's not good. It's just this most risky, but it gives you the highest return. Okay. Now additional tier 1. What are these? So I think there are a lot of definitions elsewhere that you can look into. This slide actually is from a book called Handbook of Corporate Equity Derivatives by Ramirez. It's a pretty good book if you want to check it out. I recommend you try and get a copy. It would end up helping you for this course. Okay. Now anyway, additional tier 1 is so it has a dividend stopper. That means you have to pay coupon first before you can pay dividend. Okay. Now the thought process is this. So from the point of view of an AT1, I'll call it, okay, additional tier 1, an AT1 investor, the thought process that they're going through is this. So you just invested in a piece of AT1 and it has a dividend stopper. So what do you care about? You care about whether you are going to get your coupons or not. Okay, number 1. Number 2, so you start thinking, okay, under what circumstance will I not get coupons? Okay. And that would be if if they don't pay a dividend, okay, that is the only circumstance that you will not get paid a coupon. To put it another way, if you invest in, let's say, HSBC, additional tier 1, and one day they say to you, oh, I'm so sorry, for the next quarter we can't pay you any coupons. Let's say they tell you that. You get a letter from HSBC, okay, so sorry, we can't pay you coupons. So immediately you can jump on the phone and call them up and say, okay, in that case you don't pay any coupons either for the next quarter, okay, because you can stop them. They don't pay you coupons, you stop them paying dividends. Now the point is this, unless things are really bad, normally companies do not want to shift their dividend policy from one quarter to the next. They want to maintain some kind of stability and predictability, so they don't want to alter their dividend policy easily. They certainly do not want to suddenly stop paying dividends, because that sends a very bad signal to the market, okay. So your logic is as follows, okay. If they stop paying coupons to me as an AT1 investor, I will stop them paying dividends, which will be the absolute last resort for this company to treat their shareholders like that, and they wouldn't want to do that. So I figure that, you know, as a result, the chance of me not getting paid a coupon is quite small. It's not zero, I don't say zero, but there is some protection from it, because empirically, unless they absolutely had no choice and the company is doing so bad, okay, they wouldn't want to have a zero dividend. Okay, so it's almost important. So AT1 ranks higher than stock is true. It's well, it just, this is, you know what, this is just a contractual priority, you could say, so instead of contractual subordination. So AT1 ranks higher than equity, definitely. It's not because of the dividend policy that AT1 ranks high. It just is, okay. It ranks higher. I think when you look at this diagram, and then if you can digest what I just said, you know, you should understand this question. So again, I have a matrix boxes here. So a bank, sometimes they pay debt coupons, and sometimes they don't, or they pay dividend, or they don't pay dividend. So it is possible for you to pay both dividend and coupon, of course. Or maybe you don't pay dividend and you just pay coupons. In that case, if you're a bondholder, you don't care, okay, you're still happy. Or they don't pay either one, okay. That's the one that you think has a low chance of occurrence, okay. The point is, they can't do this, okay. They cannot stop the coupon and still pay dividend, so this one will not happen, and this one, you think the chance is very low, okay. So that means that, which means that you end up focusing on the top two, okay, which is when the banks are paying the coupons. All right. Okay, now let's take a look at the next one. So I have two questions regarding the lecture of follow-on offering. From the last bullet point on slide 18, is it meant for press announcement instead of process announcement? Yeah, press announcements, I think. Yeah, press announcements. Slide 20 talks about the independence of placees and placing agent. I'm just wondering what are the considerations or implications here with the statement independence. It seems not mentioned. Well, I think when you are doing transactions in the market, it is important that the placee and the agent. Placee is the one who is receiving the assets, or the one buying. Okay, and the agent is the iBank in the middle. It is important that they are reasonably independent, so that you don't have some placees being treated favorably at the expense of some other ones. Okay, now of course, an iBank, they have a client base, and you cannot always be 101% fair to everyone, or fair is not the right word, but you cannot always treat everyone equally, but you have to strike a balance to the extent possible that you don't favor some people just because there's something going on under the table, or you have some kind of a special personal relationship, perhaps, because some of your placees are involved with the placing agent in some capacity. Okay, so that's what we mean by it's better to be independent than not independent. Okay, for that it should be pretty obvious. Okay, so everyone gets as much as possible get a fair treatment. Okay. Now, some more questions on CBs. So this one, it's about a student was reading a market report from Finance Asia regarding CB pricing, and then he quoted the initial coupon guidance is 1.25 to 1.75. Conversion premium range is 37.5 and 42.5. Final pricing was 1.25 and 42.5 conversion premium. I quote from Finance Asia. My question is whether the range of the price of a convertible bond offered by the issuer is the range of coupon and the conversion premium instead of the range of price. Is that if I subscribe for 1 unit, par value 1,000, I would definitely pay 1,000. The changing parameter is the final conversion premium and the coupon that decide upon the market demand. Yes, I like it that you try to answer your own question. Mostly you are correct. When you are negotiating on not just CBs but normal bonds as well, you are negotiating on the yield or on the coupon, and the price. You will always either pay par or maybe a small discount like 99.50 or whatever. Okay, but the price will always be somewhere around par. So if you pay par and you're getting a yield of 1.25%, it's very different from when you are getting 5%, for example. Okay, that's how bonds are issued. Okay. Is it possible that a CB is trading about the par value but the stock is lower than the conversion price? My question is whether the situation mentioned is called trading in the money. Well, the answer to your first question is yes. I think because why do you think what do you think is the reason? Well, the reason is even if an option is not in the money, so let's say strike is 100 but spot price is right now 99. It can still be substantially valuable if the volatility was high enough. So you don't need, of course, if the stock price was high, that helps, and that is the key driver. For the second question, the situation mentioned above is called trading in the money. Well, I think specifically no, but generally yes, and I'll tell you what I mean by that. If an option, let's say the strike is 100, but it's the spot price is now trading at 99, so technically, strictly speaking, you cannot say that the option is in the money. No, you cannot say that. Okay, that's just straight from the textbook definition of in the money. But sometimes when people are writing, then this in the money concept becomes halfway between a technical idea and just writing in plain English. And for example, people even say stuff like, if you buy a bond or if you buy a stock in an IPO, okay, stock, no option, just stock or bond, okay, so you buy at 100 and now the price is 102, they will say, oh, this IPO is in the money. Okay, they mean it in that regard. Now IPO doesn't have any options, okay, but they borrow the term in the money and they're using it almost in a journalistic sense to describe something that is actually making a bit of profit. Okay, that's what that means. Okay, question 3. Okay, this is regarding comparing a CB issued by Ctrip, where first of all they issued a CB, and then it seems like the issuer also bought back a call option. So the convertible grants the right for the holder to convert into new shares rather than old shares. It is the definition of convertible bond note versus exchangeable. Well, I wouldn't say it's a definition. It is it's certainly part of what happens. Okay, by construction, CBs when they are exercised would result in new shares. But I wouldn't. Definition is how you know how you describe something very precisely. And the way I would define a CB is simply, a bond plus a call option issued by the company. Why Ctrip needs such a hedging activity? Well, generally, yeah, okay, I see the point. So a CB, it's not CD, CB. Like I said, it's like a bond, okay, plus a call option. But this is from the investor's point of view. So investor is long a bond, long a call. If you are the issuer, you are short a call. So you want to buy. If you buy back a call, then what you've done in a sense is you have just issued a bond. So the question is, why not just issue a normal bond instead of going through all that trouble? Now, of course, there is a reason for that, and the reason is simple. The reason is you compare doing two things. You compare A, issue a bond, versus B, you issue a CB. Okay, now I'm talking from the investors, the issuer's point of view. So you issue a CB, and then you buy a call. Okay, now the economic result should be the same. So why would you do one instead of the other? Well, it's very simple. it's in the end, what is the net cost of doing that. If you issue a CB, if you issue a bond, and let's say you have to pay a 5% coupon, okay, I'm making this very simple now, and if you issue a CB, let's say you pay a 3% coupon, but you have a call. But if you were to buy if you have to buy the call back, let's just imagine that you need to pay an additional 1.5% per annum, okay, then your net cost when you add everything together will be 4.5%. Now that would be better than paying 5% on a straight bond. Plus, maybe there's a real demand for your CB and there's not a lot of supply out there. All of those things, okay, they come into play. Here's another one. I have a small question regarding capital market course. For a company registered in Cayman Island and listed in Hong Kong Exchange, which company law should it follow? Hong Kong Company Ordinance or Cayman Company Law? I noticed Cayman actually allows company to pay dividends using capital reserve when profit is negative, but it's not the case in Hong Kong. So is there any kind of waiver, 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 that Hong Kong Exchange allows Cayman registered companies to be out of the restriction of Hong Kong jurisdiction? Now, this is an interesting question and got me thinking. I think what you need to do is to distinguish between what I call place of incorporation, where you are actually registered for business, sometimes called a domicile, okay, and your listing jurisdiction. So a company can only have one place of incorporation. It's like, your place of birth. You cannot be born in China and in Singapore at the same time, okay. So place of incorporation, and then of course you are free to list in multiple locations if you want, but you would have at least one. Quite often your listing jurisdiction is the same as your place of incorporation, so you can incorporate in Hong Kong and you can list in Hong Kong. Where these are different, I think you generally have to follow the company law of your place of incorporation. Okay, so to answer your question, I think it's the Cayman law that applies. Now, what does it mean when you come to Hong Kong and you do an IPO? Okay, now, so you have to actually satisfy the now first of all, if you go to the website of Hong Kong Exchange, you will find that Hong Kong Exchange or the Hong Kong listing rules, they only accept to do IPOs for companies from certain countries. It is quite a big list, but it's not everybody, okay. So it's got all the main mature advanced economies, plus some emerging market countries, but it's not everyone, okay. So when you come to Hong Kong, just by them looking at where is your place of incorporation, they already have a pretty good idea whether they can handle you being listed here, okay. Now, if you want to list here, then what you do is you do have to follow their disclosure requirements, and then you have to issue a prospectus according to the Hong Kong requirements, the stock exchange here, and every year you do have to follow accounting standards. But ultimately, the law that you have to follow, I think it has to be with respect to your place of incorporation, okay. Otherwise, if you go and list in the Cayman Islands, which doesn't really have much of a stock exchange as far as I'm aware. Okay, so you list in the Cayman Islands, and every time you go elsewhere to list, whether it's London or New York or Hong Kong, you're going to follow the Hong Kong law. If you were to do that, the Hong Kong law and the English law and New York law, then there is no point to incorporate in the Cayman Islands, because the laws there would not really apply to you under any circumstance. Okay. Now this one, first, I find that there's also Greenshoe option in equity link market, but I don't quite understand how it works in this market. In IPO, underwriters can borrow up to 15% of the initial IPO size from controllers, which means the major shareholders, and sell them to investors. It's called over allocation. That is true. Then they can fully or partially exercise. They, in this case, would mean the iBanks, okay, or buy back shares from secondary market and return to shares to the borrower. But in equity link, where do they borrow the exchangeable bonds or convertible bonds, or they just issue more bonds? Well, this person already managed to answer the question. You just issue more, okay? So instead of actually borrowing from the company or the major shareholders, you just issue. Instead of, let's say you're planning to issue $1 billion, and legally, if you say to everyone you're going to issue $1 billion, you have to issue $1 billion. But if you throw in a Greenshoe, then you just issue a bit more, okay, and then you buy it back. Now, I think the emphasis here that I would like you guys to keep in mind is that the Greenshoe is nothing more than, and you remember this diagram that I drew, so this is the IB placing to A and B and C and D, and behind the supply may only be 100 million shares, okay, and then on purpose they go out and they place 115 million, and if there is not enough, then they ask for more. Okay, now when they ask for more and more is delivered, whether it's delivered from the major shareholders in case of an IPO Greenshoe, or whether they are delivered because they issue more, now that for me is just an operational detail, okay, that I don't think you need to worry too much about, okay, because what you need to take one step back and ask yourself, what is the key concept here? The key concept is this. The key concept is you on purpose create 115 million of demand and 100 million of supply. So demand is bigger than supply. Therefore, if the deal is going well, then I create extra supply, either by issuing more or by borrowing, whatever. That for me is a minor detail, okay? The point is I try to meet that supply, or if the deal is not going well, I try to reabsorb the excess demand that I created, okay? And I'm able to do that precisely because I created more demand in the beginning on purpose. Okay, that's what I'd like you to try and remember. So I hope this is helpful. I think for now, if you understand all these questions and you understand what I'm saying, you are doing quite well. Feel free to review this tutorial file number 5, which is already in Blackboard. I was hoping to be able to talk about it a bit more during tutorial, but because I didn't get a chance, so I like to try and share with you the answers here. Okay, I hope that is helpful. A good day to everyone, and take care. See you next time. Bye bye.